Hello, everyone. Thanks for joining us today. We're going to have a great webinar with Brian Tribble of Nationwide. If you have questions, please type them in the question box on your control panel at the right side of your screen. We'll answer them at the end of the presentation. After the webinar, you should get a copy in your email. If you don't get those copies, give me a call. We can send you a copy and answer any additional questions you might have. Here's a little bit about our presenter. Brian leads the legacy programs within Nationwide's advanced planning group. He specializes in farm transition and business owner planning. So we're looking for a lot of good information from him here. Thanks again for joining us today. Brian, you've got the reins.
All right. Thank you, Kip. Good afternoon, everybody. And thanks for the introduction. Again, I'm Brian Tribble with Nationwide's legacy planning team. For those of you who have not worked with our team before, we have a very diverse collection of expertise in the business planning space. So our advanced planning group has multiple specialists with any business planning expertise you could imagine: buy-sell planning, ERISA plans, executive benefits, non-qualified plans, tax strategies, income planning, estate planning, and so on. So today I'm going to talk more specifically about our business valuation service and how it can help you have more meaningful conversations with your clients and identify more sales opportunities. Before we get started, I have a few disclosures. I'll give you a second to read here, and I'll add to this. Our team is a team of consultants, so we don't give any tax advice. We can guide the conversations, but we do not give tax or legal advice or draft documents. All right. So what is business valuation? When we say business valuation, really, we're just talking about how much is a business worth. And there's typically two categories of business valuation. You have formal valuations and informal valuations. Formal valuations are performed by independent experts who have many certifications in valuation and appraisal. Formal valuations typically have to meet very specific requirements and require a lot of time and money and pretty exhaustive reporting. They're generally used for things like stock option or ESOP plans, gifting calculations, legal proceedings, or anything that might be subject to an IRS challenge or audit. When we talk about informal business valuations, those use a wider range of criteria and more general information about a target company to help extrapolate the fair market value of a business. So much less time intensive, less costly. We look at things like calculation-based valuation methods such as discounted cash flows, earnings multiples that can be applied using formulas or market comparisons. And I'll go through some of the other methods that we typically look at Nationwide. So we do offer an informal valuation approach here at Nationwide, where we can have basically enable a wide range of planning conversations without offering legal advice or using these valuation reports to satisfy an audit or in legal proceedings. To give you some background on our team and the work we're doing on the business valuation end, we've worked with over 1,000 business owners in a variety of different industries to do these valuations. So we're typically working with the small or micro-sized businesses. That's going to be your companies with under 100 employees and less than 100 million in revenue. So that's kind of our top end. We'll work with almost any company on the bottom end. I'll kind of go over our requirements a little bit later, but we really specialize in the small and micro-sized market. So why is valuation important? I would argue that for a business owner, the value of their business really is the centerpiece, not only of their succession plan, but their retirement plan and their estate plan as well. The problem for business owners is more than 90% of them don't know the value of their business, don't know how much their company's worth. So for a business owner, their company is oftentimes the largest portion of their estate and their net worth. And I kind of liken that to, imagine trying to put together an estate plan or retirement plan or a business succession plan for a client without knowing the value of their investment portfolio or their real estate holdings. It'd be nearly impossible. And that's why we face a challenge when we try to plan for business owners without having any idea of what their business is worth. Unfortunately, business owners just don't have the luxury of a robust marketplace or publicly available information to set their value. Generally, that's where a business valuation comes into play. The problem is many business owners are deterred by the time and the cost a formal valuation requires. If you do a quick Google search, you could probably find a variety of different services offering valuations from independent experts, anywhere from $5,000 on the low end to $25,000 on the high end. Those are going to typically require months of due diligence and, again, exhaustive reporting in order to produce a single value. For small business owners, that's don't need their business valuation scrutinized by the IRS. A formal valuation is typically outside of the scope of what they need and what they're looking for. And that's where an informal valuation service comes into play. We can provide a calculation-based report in a fraction of the time that it would take to do a formal valuation, and at no cost. So I know what you're thinking. What's the catch? There is no catch. This is a service that we offer as a value add for our financial advisors, because we know it sets Nationwide apart. We also know that many business owners may have gaps in their financial plan that a Nationwide solution might be able to solve. So that might be establishing a qualified plan, executive compensation, funding a succession plan, even the estate planning piece of things. And that's the goal of our program, really, is to help you navigate some of these planning conversations that your clients may either have neglected or just not really thought about in the past. So I'll get into who's a good fit for our business valuation service. Again, we're looking for those smaller micro-sized businesses, anything under really 100 million in revenue or 100 employees, we can work with. Anything above that, generally, we're going to recommend a formal appraisal be done by an independent expert. On the low end, the business has to have at least 1.5 million in revenue, and then a 5-year track record of profitability. So we don't typically work with startups. And then finally, we don't do real estate holding companies, farms, ranches, or franchises. Other than that, everything's pretty much fair game. There's a few industries we've got up on the screen here that we've had a lot of traction with, especially in the last 3 years. The first one is manufacturing. There have been a lot of variables that have impacted manufacturing companies in the last few years. You look at primarily supply chain issues we've seen, the impacts of COVID shutdowns, and then varying demand for the products and services they offer. Some manufacturers have really thrived and been resilient during the last 3 years. Some have struggled to really keep the door open. The next industry we see quite a bit of action for is construction companies, and that's construction companies in both commercial and residential markets. So in the last 3 years, we've kind of seen this work from home movement. People are starting to build and upgrade their existing homes much more frequently than they did in the past. So you've got a lot of demand in the residential market. Then you look at the commercial market, and you've got, 2021 Senate passed a $1 trillion infrastructure bill. A lot of that is going to go into investment for building and construction industry. The final group that or industry that we're seeing a lot of traction with is professional services companies. So that's going to be our law firms, CPA groups, medical practices, engineering services companies, etc. We're seeing those companies, lots of mergers and acquisitions in that space, and we're seeing companies sell at a lot higher multiples than they used to. So our service isn't limited to just these three, of course. These are just industries we've seen a lot of traction with, and it might be a good place to start if you're looking for a company to start with. So I'll share a little bit about our process and how we go about putting together a evaluation report and what that report actually looks like. So the first step of getting the valuation report is collecting a few pieces of information. So to create the report, all we need is 3 years of business tax returns in the fact finder you see on the screen here. That fact finder is 2 pages. very easy to fill out. It takes about no more than 10 minutes, and it's some pretty basic information. What you don't see on the screen here is some other information that we may be able to look over, but it's not required to do evaluation. So things like a census with company's employees, their pay and their role, and dates of birth. And then if they want to have their a company wants to have their legal agreements reviewed, we can review buy-sell agreements, pick out any holes in those, and help them make sure that those fit their needs. So from there, it takes about 5 to 7 business days once we've collected all this information to complete a valuation report, which if you look at a formal valuation or even some of our informal valuation competitors is on the very low end of time it takes to get the report complete. So here's a little bit of a look behind the scenes. Once we've collected the information, we're going to go through the tax returns. And we'll go through and we'll start by making something called normalizing adjustments. So this is a pretty standard within any business valuation. Those help us kind of simulate what a business would look like under normal operating conditions. And that helps us get businesses all on a level playing field, playing by the same rules. So normalizing adjustments might be things like making a depreciation adjustment, or adding back non-recurring or personal expenses that are deducted as a business expense. So up on the screen, we got an example of a manufacturing company. The company is an S corporation, hence the 1120S. So as we look at this first page of the 1120S, there's a couple things that we can pick out here. First, we're looking at that NAICS code at your top left. That tells us what kind of industry they're in. And we use that code to pull some information from our database that gives us access to industry trends, credit and underwriting risk, and lots of good benchmarking data that we can cross-reference with the target company's financials. Next thing we're looking at is what's their gross income look like? What's the trajectory of that gross income? So as we look at 3 years, we're going to see a trend. If we see an upward trend, that's going to be a positive. If we're seeing declining revenues, that might affect some of the assumptions that we make and devalue the business. So we see that they're making 17.8 million, this manufacturing company. The total income is 4.8 million. That gives them a gross margin of about 27%. And that would be, if we look at some of the industry data and financial benchmarks, lower than their industry peers, which the average for a manufacturing company of this kind and quality is about 35%. So those are opportunities that we might identify that could impact their cash flow, that if they can get under control, maybe puts them in a better position moving forward. So scrolling down on the tax return, a few things stick out here as well. First is compensation. So we're seeing on that top line there, officer compensation around roughly 1.3 million, which is substantial, especially compared to the salaries and wages on that next line down, which is salaries and wages that are paid to non-owner employees. That tells us that the owners are providing substantial services to the company, or at least they should be. Then we see their ordinary business income on that bottom line there, which passes through to the owner Schedule E, and that's going to be filed on their K1. That's around 1.25 million for the business. It's interesting seeing that arrangement, especially for S Corp owners. S Corp owners typically favor K1 distributions opposed to W2 wages, because W2 wages are subject to self-employment taxes. So the arrangement and the ratio they've got there between ordinary business income and officer compensation through W2 wages may need to be put under the microscope. So that's something that we would identify in this process, and maybe say talk to your accountant about that. We also see that they've got relatively low profit sharing deductions, which profit sharing contributions could be the answer to why they may be compensating themselves with W2 wages. Because they're so low, that's probably not the reason. So, we see for this company, they've got highly compensated owners, relatively low non-owner wages. may be a good time to look into the tax benefits of bolstering their retirement plan, their qualified plan, to get more tax deductions. So as we go through the rest of the tax return, those are some of the things that we're looking at and looking for. Just different little Easter eggs that might lead to another gap in their plan or an opportunity for a product or solution. So beyond the financials, there are some qualitative value drivers as well. Those might be things like, does the company offer any unique products or services? What is their customer concentration? Are they highly concentrated in their top 3 customers, or are they pretty diverse amongst a wide range of customers? That could impact their value. Do they have any intellectual property? What's their level of competition look like? And then what's their proximity to key markets? Do they have any type of future contracts they've secured that are going to bolster the value of the business? So we don't typically get this type of information because we don't ask for it. But if you can provide us with a little bit more color, that might help us make more accurate assumptions to kind of complement some of those qualitative or some of the quantitative value drivers that we look at. So here's a little bit of a snippet from our valuation report. This is one of the 8-page valuation report that we'll send to you. We'll also provide an industry profile along with detailed commentary from our team that summarizes our findings, as well as any potential opportunities that may be present on the particular target company. So you'll see on the screen we have 5 different valuation methods that we consider in our reports. We'll show all 5 for each report, but generally we're going to narrow those down to the 1 or 2 most suitable approaches for the particular business. The basis of which we apply the most suitable method is usually going to be based on capital intensity of the business. So this is an example of a manufacturing company. A company like this relies pretty heavily on plant, property, equipment, fixtures to produce their earnings. So we would favor one of the excess earnings methods, which you can see on the screen there. Excess earning methods are a combination of both an asset-based and an income-based approach. So we want to give them credit for their plant, property, and equipment and the contributions that makes to their profits, but we also want to look at the goodwill of the business as well. If we were looking at something like a consulting firm or CPA group, they don't typically rely on their plant, property, equipment, their tangible assets to produce their earnings. So we might favor in that case a straight capitalization method. That is a strictly earnings-based approach. We're not going to give them any credit or assume that any of their earnings are attributable to their tangible assets or their plant, property, equipment. For other companies that, let's say, are experiencing substantial near-term growth, we work with a payroll company that had grown year-over-year revenues by about 150% for the last 3 years. For that type of company that's experiencing that explosive growth, we might look at a discounted future earnings method that's really going to give them credit for the anticipated growth rate. So again, it takes about 5 to 7 business days to compile these 3 reports. We'll send you a copy of the reports directly, so it goes directly to you as the advisor, and then we'll generally set up a consultation call to go over our findings. So as I mentioned before, we have a lot of expertise in our group. So if we want to get into the details of any particular concept, whether that be qualified plans, executive benefits, buy-sell funding, estate planning, we've got a specialist we can tag into that conversation. So as we wrap things up here, I think the big takeaway is we do have that team of specialists who can help you navigate these conversations, and that for a business owner, the business valuation is really one of those centerpieces with any of the planning that they might do. So if they want to set up a succession plan and buy-sell agreement, they'll have to have a business valuation to determine the sales and purchase price, as well as fund it with life insurance. If you want to do an estate plan, determining the value of your estate is nearly impossible if you don't know your business's value. Then you look at retirement planning. When you go to sell, how much capital, what's your liquidity event going to be? And then how do you produce earnings from that liquidity event? So really the centerpiece of those conversations, it's a quick and easy process, and it's a good alternative to that formal valuation. which can be very costly and very time intensive. So I would encourage you to think about any existing clients or prospects who may own a business that might be a good fit for the valuation. Again, we're looking for businesses kind of on the small micro size, anywhere from 1.5 million in revenue to about $1 million in revenue. If somebody comes to mind, we can get you set up with all the information you need. We've got a couple good marketing pieces that help start the conversation. Then we have our fact finder, as well as some sample reports, which I can send over to Kip, and he can get over to you. So if you have a potential business owner and you'd like to submit a request for evaluation, work through Kip. It's a very easy process. Again, some very basic information. We turn it around very quick. And Kip and Charlene can help you get set up with our team. So that concludes my remarks for today. Kip, I'm going to pass it back over to you. First, I'll entertain any questions that you might have, or is there anything that I missed?
Thanks, Brian. Yeah, we do have a question here. This person wants to know, what's the experience or background of your in-house team that's doing these evaluations?
Yeah, so myself and my teammates who do the valuations, we've got a business planning background, so CFP, CHFC, CLU, and 2 or more years in experience in doing the valuations. Again, they're informal, so we're really just pulling qualitative information from the financials of the business and using some assumptions to put those in place. Then we've got the surrounding team with the diverse background we've got. Probably 4 JDs that we work with pretty frequently that review most of these cases. They help us do the legal planning with it. We've got JDs and CPAs in our group. And so their expertise we tag in from time to time, just based on what the complexity of the case is.
Gotcha, thank you. And then another one, and I think you covered this, but I'll ask it anyhow. What's the time frame from when you receive all the documents and information of everything that you need to get that informal evaluation back out to the business owner?
Yep, it takes 5 to 7 business days. We say 7. We usually get it out in 5. So from once we get everything, so that means we've gotten 3 years of tax returns from the business, as well as the fact finder. The clock starts then. We'll get it back to you within 5 business days.
Okay, great. I don't see any more questions here. Thank you, everyone, for joining us today. And thanks, Brian, for all the great information. If you need a copy of this or have additional questions, feel free to call us or email us. The information's on the screen there. If you need an illustration or need to start this process, obviously get a hold of me. I'll be in touch with either Charlene or Brian, both. Again, thanks, everyone, and everybody have a great day now. That's it.
Thanks, Kip. It was a pleasure.
Have a good day.